Hello, distinguished students of Lagos State University. It's my pleasure again to welcome you to our second lecture on BFN 101 Introduction to Finance. Today, we shall be looking at the scope and functions of finance. You will recall that last week we looked at the conceptual definition and types of finance, and we examined the various types of finance that's available and the way people misconstrue finance and not actually realizing that it is a daily application. But now we will look at the scope. What does it cover? And what are the objectives? Why is it actually important? This will help us to drive home and what we actually learned last week. It will begin to relay finance to you in a different perspective, and you begin to come to realization of some aspects of finance. And like I've told you last week, I am your facilitator, and the ride promises to be very interesting, very enjoyable, and a thing that you continue to learn, and enjoy and actually fall back to over time. So, what are we waiting for? It's time to go ahead. Let's go into the lesson, and you are welcome. Thank you. BFN 101 Introduction to Finance. The second lesson, the scope actions. In this lesson, we are going to look at the important and vital aspect of businesses, which are ability to choose, to make right choices of viable ventures. We will look at the possibility of generating funds to finance a venture. Peradventure, you are looking at starting a business. How do you get it sufficient funds? Even if you have some money, it's possible that money is not even adequate. Where do you look to get additional funds that will make that project a reality? Also, investment decision, which we've talked about in our previous lecture. We are concerned with possibility of sourcing for funds, or what we call the capital mixed decision. This decision to source for funds and the limitations, the objectives, the benefits, we will be looking in this study. The various forms of earnings that a corporate organization could actually engage in. We will also be looking at finance as the backbone for all functional organizations in any economy. In fact, finance is the backbone for every individual in any economy. And finance is also the backbone for even the government in any economy. Before you get anything done, it becomes a very crucial prerequisite for individuals, enterprises, private, corporations, and the public. Without it, you cannot do anything. It also becomes a necessary tool for maintenance and ensuring compliance with commitment to individuals and groups who consume its output of goods and services. So in this particular module, it consists of 2 units. The first one is the scope and functions of finance, which is what we'll be looking at in this lesson. And by the next lesson, it will be the organization of financial functions. So what we intend to achieve by this lesson, we would like you to know the factors that influence the sources of finance. What are the benefits and disadvantages of the various sources that we will be discussing? And we would also like you to understand the various functions of finance, the capital structure in a typical firm. How does a company engage in capital structure? What makes? I mentioned that in the last lesson. Then you also we will discuss the four main functional parts of finance. And then the functional parts, we will now pick each of the functional parts and discuss their components in this lesson. Then we also let you understand that the scope of finance is narrow, but it's very deep. It's very, very deep and highly applicable. So in this lesson, we'll look at the functions of finance, the objectives of finance, the types of managerial decisions in finance, and the factors that influence the factors that influence financial decisions. So let's pick the first one, which are the functions of finance. What does finance have to do? Without finance, no business can survive. So the long and the short run existence of any venture, any business, any entity, any government lies in finance. It ensures the short and long run survival of the business. It serves as a tool that ensures production, marketing, record keeping, and financial activities that are done on a daily basis or are done on a continuous basis. That serves as a tool. You want to engage in production? You need finance. Marketing, record keeping. It is very, very germane. It applies to all business. And that's why I said no business can survive. So the seriousness with which finance is handled in any organization determines how well the business is run and the level of success that will be achieved in such businesses. If the finance is pushed to the background, such business is not likely to survive for a long time, even in the short run. Finance must be taken with every measure of seriousness. Every amount spent must be accounted for. Every source of income must be accounted for. Both the income and the expenditure must have proper documentation so that people will know what is. It includes the study of asset utilization. When you purchase an equipment in an organization, suppose a generator or a vehicle, within this page, the amount you use to acquire the asset will not be consumed within a particular period that you are considering. With finance, it's possible for you to know what percentage have you actually consumed, what percentage of the asset is actually left. Like a vehicle, that will come under the term depreciation. By what percentage has that asset depreciated? Maybe looking at the asset as being new, but not necessarily that it is new. So it comprises of capital management. What form of capital are you looking at? Is it ordinary shares, preference shares, or debentures? What type of capital management or long-term debts that you are looking at? Because the capital mix of an organization involves capital and debt. Also the short-term debts, maybe in form of your debtors and creditors within the organization, and also the profitability maximization. How do you maximize that? All this comes under asset utilization, enables us to discuss the functions of finance. Now, the objectives of finance allows us to assess our financial requirements. You are able to place figures on actually how much and determine whether those funds have been properly utilized, because you can make comparison. It assists us to increase our profitability. You can determine, no, I don't want a 20% income investment. I will go for a 30% income investment. It is finance that assists us. It also assists us to maximize the value of the firm and then to minimize the cost of production and engage in what we call economy of large scale. For our first activity, let us think about the finance function that you have participated in before and appraise how it was done based on the criteria in this lesson. Can you think of one and make a note about that particular finance function and what have you learned in this lesson and how it was actually done? Now let's look at the finance function. We have 4 of them: planning and budgeting, resource allocation, operating, monitoring and safeguarding, evaluating and reporting. These are the 4 key finance functions, and we'll be picking each one of them and then discuss them a little further. To handle all these things, we have the finance manager who deals with the various functional departments. You have marketing, you have production, you have sales, so many departments, even administration. Well, the finance managers act as a central hub and relates with all these departments or sections like marketing, which I've talked about, production, personnel, system development, research, development, and so on and so forth. But he serves as the central hub. Very, very important that the finance manager has a knowledge about all these areas, because it will be part of the decision-making process in all those sections. Because if he says, I have 10 naira for you, he has to justify why he's giving 10 naira to sales and giving 2 naira to personnel. The finance function involves 4 types of managerial decision, and these are investment decision, finance decision, dividend decision, and liquidity decision. And the decisions are what we're looking at. The first one is the budgeting, planning and capital budgeting decision. This is a process of planning and making investment decision for the purpose of capital expenditure. Capital expenditure relates to expenses that are on capital items like generator, like vehicle, like house, or purchase or building of a house or building. All those things are capital expenditure. And how you plan, the process that it takes you to decide on the decision comes under the planning and capital budgeting decision. And these are expenditures, the benefits of which are expected to be received over a long period of time. Because if you build a house, you cannot get the return immediately. Nobody's going to, suppose you build a house with 50 million or 100 million. The best you can get from the house, from such a house, where you are not selling, is to rent it out for a value, maybe 1 million or 2 per annum. So if it is like 2 million, it's going to take you about 50 million. The cost was actually 100 million. So the benefits will be over a very long period of time that would exceed a year, depending on the type of assets involved. The finance manager therefore has to assess the profitability of the various projects before committing the funds and look at other options available Are there other sources where the profitability and the recouping of the capital will be faster than this one, and the risk is minimal? Definitely, it will try to go in for such. The investment proposal should be evaluated in terms of expected profitability, the cost involved, and the associated risk. These are the typical things that you actually want to consider when you are looking at capital budgeting. The next one is the financing decision or the capital structure. This deals with the optimum mix of financing for a firm. What are the types of finance that you actually want to consider? Should you go for strictly capital, or you want to go for a combination of capital and long term, or you want to go for a combination of capital, long term, and short term funds? And once the firm has taken the investment decision and committed itself to a new investment, it must decide the best means of financing these commitments. And that is what I've discussed before. Each type of capital or fund financing mix has its merits and demerits. If it is capital, strictly capital, and it is ordinary shares, you definitely they are the owners of the business, and they will take the last place in pace to recoup their funds should the company be wound up over time. And if it is long-term funding, definitely it has its merits and demerits. And also the short-term funding, like your debtors, which you can, but you need to look at the mix, the industrial standard, and the merits and the demerits of the mix you choose. Therefore, a finance manager, you must select sources of funds that will give you optimum capital structure. The sources that will optimize your financial structure. That is a very good role of a finance manager. The next one is the dividend decision. The investors in capital, most especially the ordinary shares, preference shares, the way you prepare them for parting with their money is payment of dividend. And that is one of the key areas that convinces investors to put money into that business. If the dividend is very low, there is a possibility that investors will withdraw their money, which is not a good thing for any business. You don't want investors to come and be pulling out their money, because it will send wrong signals to the public about your business, and even others too will be running away from you. So it is a very, very important decision. And it is a percentage of profits that is allocated to dividend, who supplied money to the company. It refers to that part of profit of a company which is distributed amongst the shareholders. Dividend decision is a quantum of earnings that is distributed. Suppose you, as a company, you've been able to make 100 million. At the management meeting, the board could decide, the board meeting, they could decide to give 20% of that earnings to be shared as dividend, and that will assist the shareholders. It's a decision that has to be taken whether all the profits are to be distributed. I will never recommend that, because if all the profits are to be distributed, the company has nothing to fall back upon. When you see a company that distributes all the profits, I will be a bit careful in investing in such a company. or retain all the profits in the project, I wouldn't also support that. Could be done in extreme cases of previous back losses to bring the company back to the expected level, and thereafter keep a part of the profits in the business and distribute others among the shareholders. That is what I will go for. Everybody has something for what they invest in the company. So the fourth one is the liquidity decision. This is very, very important. If there is an improper liquidity decision, the company will flow into insolvency. And if from illiquidity, the company moves into insolvency, and from insolvency, the company will eventually be wound up. So a critical aspect of decision is liquidity decision. You monitor and you safeguard the company from illiquidity. And that determines, it's a function of the credit and the debit that you take, the credit you give and the debt that you take from people. And this can be achieved by ensuring that your current liability is equal to your current assets. That is a 1-to-1 ratio. And if it is not a 1-to-1 ratio, the divergence should not be too far apart. In essence, whatever you are owing in the short run, you must have more than sufficient to pay for it in the short run, not in the long run. Because before the long run, those short run commitments could lead your company into insolvency. And that is bad for the company. So current ability must equate current assets. What are the factors influencing financial decisions? There are so many factors, but some of them we will discuss about here. The capital markets and money markets, they play crucial factors. If a company needs money from the capital market to raise funds from the capital market and it is not available, you will not be able to get going. If you need loan from the bank representing the money market and it is not available, you will not be able to get going. The state of the economy. If the economy is in a bad shape, everybody feels the impact and it's not good for financial decision. The requirement of investors. If you make it very, very convenient and comfortable for investors to come into your company, to your territory and invest, then definitely it's a good thing that aids financial decision. The government policy, the simpler it is, without compromising, the better for everybody. We try to remove the bottlenecks and the bureaucratic processes in government policy formulations and requirements. That helps all of us. The concept now is KISS, keep it simple. Keep it so simple. The taxation policy, we try to remove all the double taxation that we have in all our territories. And let us go for single taxation. And the financial institutions and bank lending policy. Presently in Nigeria, we're all complaining about 2-digit lending rates. That is not too good for us. All this influence financial decision. And you see so many good projects, but the lending rate does not support the people. And under the concept of lemons, you will see that it's the bad people who don't have the intent of repaying back that will be going for the money, because a genuine investor will think twice and will not want to start a project that will land him in being unable to pay for the. Our second activity for today, again, to ensure that you understand the functions of finance and managerial decisions involved, or you should close your book and try to recall the 4 managerial decisions with a brief explanation on each of these activities. Secondly, you should try to explain the factors that influence all these managerial
My pleasure again to welcome you to the week 2 of the lesson that we've been having. So far, we've discussed today about the scope and functions of finance. And possibly you have some questions that are bothering your mind. Feel free, but I have with me here 2 of our students. On my left is Oladele Ayobanikale, and to the right is Sheung Apata. They have also listened to the lesson that we had today. And Oladele, do you have any question concerning the lesson?
Yes, I do, ma'am.
Oh, please feel free to ask me.
Okay, ma'am. I'd like to ask, ma'am, how was the requirements made by investors affected and influenced the financial decisions, ma'am?
Oh yes, the investors, definitely, if you make things difficult for anybody, they are not likely to want to come to your domain for wherever. So the better, the easier it is, the better. So what we are saying is, for financial decisions, when investors have it easy, though not necessarily compromised, it aids financial decisions. Now let me ask you, suppose when you came to LASU, we asked you that you need to move to Victoria Island to get your student's identity, how will you feel?
I will feel very bad.
Exactly. So making it easy for investors is part of what aids financial decisions in a positive way for the economy. I hope that is clear to you. Now over to you, Apata. Do you have any question for me?
Sure, ma'am.
Okay, please go ahead.
Ma, we've talked about the financial decisions. I would like to ask, how has the money market and capital market affect financial decisions?
Money market and capital markets. The last financial crisis of 2007-2008. Are you aware of how much the capital market in Nigeria plunged?
I really can't say. I'm
Okay.
not sure.
Okay. We could, as at that period, a lot of investments that were like 40 naira in value went down as low as 5 naira. Because the world is a global village. Whatever is happening in US under the concept of contagion will affect Nigeria. That is why the capital market and the money market, which comprises of the stock exchange, the banks, they have high impact on the economy. Because if they are not able to, suppose your salary or your student's loan was paid into your bank. Which bank do you use, by the way? GT. And you get to GT, and GT says, please come back next week. We don't have enough money. How do you feel?
I'll feel very bad.
Exactly. That is why it is important that for the capital market and money markets, they must be active, and they must be viral and very strong for the economy to survive. And that is an important aspect of finance. I hope that satisfies you.
Yes, ma'am.
So once again, fellow listeners, we have talked about this second lesson in BFN 101, which is Introduction to Finance. I hope you've learned 1 or 2 things. Thank you very much. Bye for now.
Conclusion. We have so far discussed the functions of finance and the various composition. We have also discussed the primary purpose of finance, core objectives that makes it important. We've looked at the 4 types of managerial decisions in finance, and we examined factors that influence financial decision. We've used this week to build on our knowledge of finance to assist us to appreciate the beauty of finance. So next week we shall be, in the next lesson, we shall discuss the organization of financial functions. I hope you have been blessed by this lesson and you are happy to have spent this time with us. Thank you for your time. Bye for now. See you at the next lesson. Bye.